Welcome to the Deep Dive. Today we're really getting into the weeds on exchange-traded funds, ETFs, and some pretty surprising ways they handle taxes. We're talking strategies that are honestly quite sophisticated.
Yeah, almost like financial wizardry sometimes.
Exactly. And you might be dealing with what people call a good problem, right? Sitting on maybe some big gains from the market lately. Perhaps you've got a lot tied up in one stock, like NVIDIA, or just broadly in tech.
A very common situation these days.
For sure. But the headache is, how do you diversify? How do you rebalance without, the tax man taking a huge bite? A lot of you probably feel kind of stuck. You want to adjust your holdings, but you just don't want that massive tax bill.
It's a real constraint.
So our mission today is to unpack how ETFs, using some unique tax rules, and these innovative structures like Section 351 exchanges, can offer a powerful shortcut for managing exactly these kinds of situations.
That's right. And, while most investors get the basics, ETFs offer liquidity during the day, they have low fees, they're generally tax efficient. The deeper mechanics, like how they pull off that tax efficiency, that often gets overlooked.
Kind of a black box.
It really is. And it's also become a pretty significant topic in policy circles lately. So we'll dig into the core stuff that lets ETFs work their tax magic and look at how these innovations are really changing investment management.
Okay, so let's start at the beginning. To get this tax magic, we need to understand how ETFs actually work. Fundamentally, how do they operate, and why is that different tax-wise from a regular old mutual fund?
Okay, so the key difference is really about who the ETF mainly deals with directly. It's not you, the individual investor, buying one share at a time. It's these large institutional players called authorized participants, or APs.
APs, right.
These APs are the only ones who transact directly with the ETF issuer, and they do it in huge chunks called creation units. Think like 50,000 ETF shares at once.
Wow, okay.
And usually they don't pay with cash. They exchange a basket of the actual stocks or bonds the ETF holds, maybe with a tiny bit of cash to true things up.
So they're swapping stocks for ETF shares, basically.
Exactly. Now you, the everyday investor, you just buy and sell your individual ETF shares on an exchange like the NYSE, just like trading Apple stock. The price floats based on supply and demand.
But how does that market price stay close to the actual value of all the stocks inside the ETF, the NAV?
That's where the APs come back in, using arbitrage. If the ETF shares start trading for, say, less than the value of the underlying stocks, the NAV and AP can buy up those cheap ETF shares on the market.
Okay.
Bundle them into a creation unit, take that unit back to the ETF issuer, and redeem it for the actual underlying stocks, which are worth more. Pocket the difference.
Risk-free profit, basically.
Pretty much. And if the ETF trades above its NAV, they do the reverse.
Right.
Buy the underlying stocks, create a new ETF unit, sell those ETF shares on the open market for the higher price. This constant arbitrage keeps the ETF's market price very, very close to its NAV.
Okay, that makes sense. But where does the tax advantage come in? You mentioned redemptions.
Yes, this is the absolute cornerstone. It's how the ETFs handled those redemptions by the APs.
Right.
Remember, the AP gives the ETF a creation unit, and the ETF gives back the underlying securities. This is called redeeming in kind, handing over actual stocks, not cash.
Okay, in kind, got it.
Now, here's the kicker. Section 852b6 of the Internal Revenue Code. This rule says that when an ETF distributes appreciated securities, stocks that have gone up in value, to an AP during one of these in-kind redemptions, the ETF itself does not have to recognize a capital gain.
Wait, say that again? They give away stock that's worth more than they paid for it, and there's no taxable gain for the ETF.
Correct. For the ETF, it's a non-taxable event. Now think about a traditional mutual fund. If people are pulling money out, or if the manager wants to sell winners to rebalance, the fund sells those appreciated stocks.
It triggers a capital gain.
Exactly. And the mutual fund has to distribute those realized gains to all the shareholders who are left, usually once a year. That's why you get those sometimes surprising capital gain distributions from mutual funds, even if you didn't sell any shares yourself.
Right, the phantom income.
Yeah. ETFs, because they can push out those appreciated stocks tax-free using in-kind redemptions, often have zero capital gain distributions, even if the fund is actively trading internally. It's a huge structural advantage.
Okay, that's a big deal.
Yeah.
But the ETF industry often says this is just tax deferral, right? They argue you, the investor, still pay tax eventually when you sell your ETF shares.
That's the standard line, yes, deferral.
But some tax experts are saying, hang on, it might be more than just deferral. What's the debate?
This is where it gets really interesting and frankly quite controversial.
Yeah.
The critical view is that while deferral is part of it, Section 852b6 can actually lead to permanent tax avoidance on a big chunk of the gains generated inside the ETF.
Permanent avoidance.
Think about that appreciated stock the ETF gives to the AP. Let's say the ETF bought it for $10, it's now worth $100. That $90 gain. When the ETF hands that stock to the AP in kind, the gain isn't transferred to the AP's tax basis, nor does it stay inside the ETF to be taxed later. It just vanishes from the perspective of the ETF and its remaining shareholders.
Ooh, gone.
Poof. Gone from the ETF's tax books. So you, as the long-term ETF investor, might never pay tax on the gains the fund realized on your behalf by selling winners internally, because the fund used in-kind redemptions to purge those gains.
So you only pay tax on your own gain when you sell the ETF share itself.
Exactly, which could be much less than the total gains realized within the fund over the years. Critics obviously jump on this. They argue, tens of billions of dollars in tax revenue might be lost each year because of this.
What?
They also talk about fairness, like why should ETFs get this break when mutual funds holding similar assets don't? Does it create inequitable disparities? And does it mostly benefit wealthier investors, potentially worsening income and wealth inequality? These are serious policy questions being debated.
It really sounds like with this mechanism, ETFs could offer tax treatment that's potentially even better than, say, an after-tax IRA or Roth IRA in some ways. You get the deferral, maybe some avoidance, and you still get the step up in basis if you hold the shares until death.
That's a comparison some critics make, yes. The potential for indefinite deferral or even outright avoidance plus the step-up is a very powerful combination.
Okay, so these in-kind redemptions are powerful. But you also mentioned ETFs sometimes extend their use beyond just handling normal investor outflows.
That's right. And this leads us to something called heartbeat trades. It's a fascinating and, again, somewhat controversial tactic.
Heartbeat trades, what are those?
Okay, imagine an ETF manager wants to get rid of a bunch of stocks that have huge embedded gains, low-cost basis. Selling them would normally create a taxable gain inside the fund, even if it could be purged later with regular redemptions.
Right.
A heartbeat trade is essentially a prearranged deal with an AP. The AP first creates new ETF shares by delivering a specific basket of securities to the fund. Then, almost immediately, maybe the next day, the AP redeems roughly the same value of ETF shares, but takes back a different basket of securities, specifically the high-gain, low-basis stocks the manager wanted to ditch.
So it's like a swap engineered just to get rid of specific appreciated stocks without selling them.
Precisely. It's not driven by actual investors coming or going. It's a manufactured in-and-out transaction, the heartbeat purely for tax management. It lets the ETF cherry-pick its appreciated securities and remove them tax-free via the 852b6 rule.
And is this common?
Apparently, yes. One study found something like no fewer than 2,261 heartbeat trades, adding up to $330 billion since the year 2000, used by both passive and active equity ETFs. It's a known technique.
And what about regulators? The SEC.
Well, interestingly, SEC Rule 6C11, adopted in late 2019, aimed to modernize ETF regulation. It made it easier to launch ETFs, but crucially, it explicitly allowed ETFs to use custom baskets in their creation and redemption processes with APs.
Custom baskets, meaning not just the standard pro rata slice of the portfolio.
Exactly. They can negotiate specific baskets with APs, and some observers see this explicit permission for custom baskets as basically a securities law blessing for heartbeat trades, or at least facilitating them. The expectation was that this rule would likely accelerate the migration of assets, especially from high net worth investors, out of mutual funds and into ETFs.
Any prominent examples of using these kinds of mechanics?
Well, the most famous is probably Vanguard's unique dual-class structure. Their ETFs are actually just a share class of their existing mutual funds.
Oh, right. I've heard about that.
This structure allows the mutual fund itself to benefit from the ETF's in-kind redemption mechanism. When APs redeem shares of the Vanguard ETF, the fund can give them appreciated stocks, removing those gains from the entire pool, benefiting both the ETF shareholders and the traditional mutual fund shareholders.
So the mutual fund holders get some of the ETF tax magic, too.
Exactly. There was a famous example around the Monsanto acquisition in 2018, where this structure reportedly allowed Vanguard funds to avoid billions of dollars of gains. Now, Vanguard had a patent on this dual-class structure, but it expired in 2023. So we might see other fund families try to replicate it.
Given all this, these heartbeat trades and custom baskets, could the IRS challenge this? Could they step in?
It raises a really important question. The IRS does have tools. They could potentially use long-standing legal doctrines like substance over form or the subtransaction doctrine.
Substance over form,
Mm,
meaning look at what really happened, not just the technical steps.
exactly. The IRS could argue that a heartbeat trade, despite its technical steps, is substantively just a taxable sale or exchange by the ETF designed purely for tax avoidance. If they successfully argued that, they wouldn't need Congress to pass a new law. They could potentially recharacterize these trades as taxable right now and maybe recover significant portions of that potentially avoided tax revenue. It's a space to watch.
Okay, fascinating. Let's shift gears a bit. We talked about feeling stuck with appreciated assets. What about those really locked up portfolios? You've done great, maybe your tech stocks soared, but now diversifying means a massive tax hit, leads to that investor inertia.
Right, you just sit tight because the tax cost of moving seems too high.
Is there another tool in the ETF toolkit for this?
There is, and it's quite powerful, though maybe less well known. It's using Section 351 of the tax code.
Section 351.
Okay.
You mentioned the 1031 exchange for real estate earlier, allowing tax-deferred swaps.
Yeah, swapping one investment property for another. Think of Section 351 as something conceptually similar, but for contributing assets like stocks into a corporation, in this case, a newly formed ETF in exchange for shares of that corporation, tax-free.
So you can swap your existing portfolio for shares in a new ETF without triggering taxes.
That's the potential, yes. Under Section 351, if you meet the requirements, you can transfer your appreciated portfolio into a brand new ETF and receive shares in that ETF without it being a taxable event right then. You get what's called a carryover basis. The ETF shares you receive inherit the original cost basis of the stocks you put in and a carryover holding period. The tax clock doesn't reset.
Okay, that sounds powerful. What are the catches, the requirements?
There are definitely key requirements. First, the control requirement. The person or group of people transferring the assets into the new ETF must own at least 80% of the ETF's shares immediately after the exchange.
So this isn't for putting stocks into an existing giant ETF like SPY. You have to be essentially seeding a new fund.
Exactly. It primarily works when you're among the initial controlling contributors to a newly created ETF designed for this purpose.
Okay, 80% control. What else?
Second, diversification compliance. This is crucial. The portfolio you contribute must already be reasonably diversified before the exchange. It has to meet the statutory 2550 test.
2550 test.
It means no single stock or issuer can represent more than 25% of the portfolio's value, and no 5 stocks combined can represent more than 50% of the value. This test is applied before you contribute.
So you can't just contribute like 90% Nvidia stock tax-free.
Correct.
Yeah.
If your portfolio is super concentrated before the swap, it generally won't qualify for the tax-free treatment under the specific rules related to investment companies. The diversification has to be there beforehand.
Okay, that's a big limitation for some people. Any other rules?
Yes, eligible assets. The stocks or bonds you contribute have to fit the investment strategy outlined in the new ETF's prospectus. So you couldn't put foreign bonds into a U.S.-only large-cap equity ETF.
Makes sense.
And certain things generally can't be contributed this way, like shares in traditional mutual funds, private company stock, private REITs, restricted stock units, RSUs before they vest and settle, or direct holdings of crypto. However, existing U.S.-listed ETFs are generally eligible, and you can look through them for the diversification test. Cash and government bonds can also go in, but they don't help you meet the diversification test itself.
Okay, so it's complex. Seems like you'd need advisors and custodians all on board.
Absolutely. For advisors, it involves getting specific client permission, meticulous record keeping of the original cost basis, and purchase dates for every single share being contributed, and tight coordination with the ETF sponsor and custodian.
And I assume launching a new ETF isn't cheap.
No, it's definitely not. Startup costs for a 351 conversion ETF are typically higher than a standard ETF launch, maybe around $100,000 versus $50,000 ballpark. And generally, you need a pretty substantial amount of assets, often cited as a minimum of $50 million or more in AUM, to make the ongoing costs economically feasible.
50 million. Okay, so maybe this isn't quite for everyone just yet. You hear someone like Meb Faber at Cambria calling this a revolution that's democratizing investing and saying it should be available to investors everywhere. Is it really moving beyond just the ultra-wealthy?
That's a really good question. I mean, historically, yes. Big institutions like Goldman Sachs have done massive 351 exchanges, billions of dollars. But the trend is broadening. Reports suggest over 100 such conversions have happened now, often involving groups of separately managed accounts, SMAs, rolling into a new ETF structure.
So pooling smaller accounts together to meet the minimums.
Potentially, yeah. And it's important to distinguish these modern 351 ETF conversions from the older style exchange funds, like the ones Eaton Vance has offered since the
Right,
70s.
how are they different?
Those traditional exchange funds are usually private partnerships. You contribute your concentrated stock, they pool it with others to diversify, but you typically face a long lockup, like 7 years, before you can easily withdraw. Plus, they often have high minimum investments, 100K to $5 maybe, high fees, limited availability, unpredictable capacity, and usually require you to be an accredited investor.
Okay, less flexible.
Much less flexible. The new wave is creating actual publicly traded ETFs via 351. Think of funds like Stance's Sustainable Beta ETF, or Cambria's own Tax-Aware ETF, or Longview's Advantage ETF. These were among the first wave of publicly seeded ETFs using this model, making it potentially more accessible.
Still sounds complex to execute, though.
Oh, definitely. Meb Faber himself acknowledges the process can be very manual right now, involving lots of paperwork and coordination. But he's optimistic that software eventually solves this, making it more streamlined and scalable in the future.
So let's bring it back to the investor. Why go through all this trouble? What's the payoff?
The potential payoff is significant, especially over the long term. One analysis looked at a hypothetical scenario, a portfolio with big embedded gains. Using a Section 351 exchange to move it into a new ETF resulted in a projected 7.3% after-tax, after-fee return over 20 years.
Okay, 7.3%. How does that compare?
It beats simply liquidating the portfolio, paying the tax up front, and buying existing ETFs that yielded only 6.7%. And interestingly, it also beat just doing nothing and letting the original concentrated portfolio ride, which came in at 7.0%.
Wow, so the tax deferral and the ability to rebalance tax efficiently within the ETF wrapper really added up over time.
Exactly. It highlights the financial drag of taxes and the benefit of deferral. Now remember, the diversification rule of 351 exchange might not solve the problem if you have, say, 90% of your wealth in one single stock, because you have to be diversified before the exchange.
Right, it doesn't magically diversify a super concentrated position on day one, tax-free.
Correct. But for portfolios that are already somewhat diversified but still have large gains you want to manage, it can be a powerful tool for de-risking and shifting the allocation more strategically without that immediate tax hit.
And what about the costs? Are these 351 ETFs more expensive?
Generally, yes. Because of the extra legal, operational, and administrative complexity involved in setting them up and managing the carryover basis, these publicly seeded 351 ETFs often have higher expense ratios. You might see, say, 0.49% compared to maybe 0.15% or less for a plain vanilla index ETF tracking the same market segment.
So there's a trade-off. You're paying a higher ongoing fee for that upfront tax efficiency and the specialized structure.
Precisely. It's part of the calculation you need to make.
Okay, well, this has been a really deep dive, really unpacking the often hidden complexities and, frankly, surprising advantages of ETF tax strategies. It seems clear the benefits for investors, especially those with gains, can be substantial.
Absolutely.
But it's also clear there's a robust, ongoing discussion about the bigger picture, tax revenue, fairness, market structure.
Yeah, definitely. If you sort of connect all these dots, the long-standing Section 852b6 rule enabling in-kind redemptions, the evolution into things like heartbeat trades, and now the rise of Section 351 conversions, you see this constant innovation pushing the boundaries of how wealth is managed and, importantly, how it's taxed.
Or perhaps how it avoids being taxed.
Well, that's certainly the crux of the policy debate. We've seen how ETFs can help unlock those locked-up portfolios, but also how practices like heartbeat trades raise questions about tax avoidance, issues that, as we mentioned, are getting attention, even congressional scrutiny. It highlights this dynamic tension in finance.
So as we wrap up, here's maybe a provocative thought for you, the listener, to mull over. We've talked about these really powerful, though sometimes debated, tax optimization tools built into ETFs tools like 852b6 and 351 exchanges. As these become potentially more widespread, more accessible, maybe even more democratized, as Meb Faber hopes, how might that not only reshape your own investment strategy or the entire financial advisory landscape, but could it, down the line, fundamentally alter our very definition of taxable income, or even change the way capital flows through the broader economy in the years ahead? Makes you wonder, doesn't it?